I want to start this audiobook by saying something that you may have needed to hear for a long time. Your financial struggles are not entirely your fault, not even close. That is not a permission slip to stop trying. It is not an excuse to hand responsibility to someone else and walk away. What it is the truth. And the truth matters, because the story you believe about why you are struggling determines whether you spend your energy fixing yourself or fixing your strategy. And most people have been fixing the wrong thing for years. The dominant narrative in American financial culture is one of pure personal responsibility. You are struggling because you spend too much, because you lack discipline, because you made bad choices, because you didn't work hard enough, save enough, sacrifice enough. This narrative is everywhere. It is in self-help books, Sunday sermons, and the comment section of every article about economic inequality. And it contains just enough truth to feel completely true, which is precisely what makes it so dangerous. Yes, individual choices matter. They matter enormously. This entire audiobook series is built on the belief that what you do with money changes your life. But individual choices happen inside a system. And that system, the American economic system as it currently operates, is not a neutral playing field. It is a structure with rules, incentives, and institutions that were built at specific moments in history by specific people with specific interests, and those rules do not benefit everyone equally. The poor and the middle class in this country are not struggling because they are less intelligent, less hardworking, or less deserving than the wealthy. They are struggling because they are playing a game in which the rules quietly favor those who already have capital, already own assets, already have access to the right institutions and the right information. And nobody handed them the rulebook. This audiobook is the rulebook, or at least the part of it they never wanted you to read. We are going to go deep today. We are going to talk about how the American economic system was designed, how it maintains itself, how it extracts wealth from the bottom and the middle while concentrating it at the top, and, most importantly, how you navigate it with your eyes open. Because knowing the game does not mean you lose. Knowing the game is the only way you win. America was built on a promise. Work hard, play by the rules, and you can get ahead. It is the foundational myth of this country, and like all powerful myths, it contains real truth alongside carefully omitted context. The truth. America has produced extraordinary social mobility. Immigrants have arrived with nothing and built generational wealth. People from poverty have reached the highest levels of business, politics, and culture. These stories are real, and they matter. The American economy, at its best, is a genuinely powerful engine of opportunity. The omitted context. Those stories are the exception, not the rule. And over the past 5 decades, the exception has become harder and harder to become. In the 1970s, a child born into the bottom fifth of the income distribution in the United States had roughly a 1 in 3 chance of making it into the middle class as an adult. Today, according to research from economist Raj Chetty and the Opportunity Insights project at Harvard, that probability has declined significantly, and the United States now ranks below most other developed nations in actual intergenerational economic mobility, below Canada, below Germany, below Denmark, below Australia. The country that invented the American dream now delivers it less reliably than almost any of its peers. This is not a political talking point. It is a measurable, documented, peer-reviewed fact. And it deserves to sit with you for a moment before we go further, because if you grew up believing that hard work alone was the variable that determined your economic outcome, and if you have worked hard and still feel stuck, the data is telling you something important. The variable was never just effort. It was also always a circumstance. The circumstances that predict economic outcomes in America with disturbing accuracy include the zip code you were born in, the wealth level of your parents, the color of your skin, the quality of the public school you attended, whether your family owned or rented their home, and whether anyone in your household ever explained how money, credit, investing, and taxes actually worked. None of those things were in your control at birth. All of them shaped your starting position in a race that the culture insists is fair. Now here is where this gets important and actionable. Understanding that the playing field is not level is not a reason to give up. It is a reason to stop playing by assumptions that were never true in the first place. The person who knows the field is tilted adjusts their footing. The person who believes it is flat keeps falling and wondering what is wrong with them. Let's talk about the mechanics. How, specifically, does the American economic system move money away from the poor and the middle class and toward those who already have capital? This is not speculation. This is architecture. And it operates through several distinct interlocking systems that most people encounter every day without recognizing them for what they are. Start with banking. If you have money, banks pay you to keep it there. If you do not have money, if your balance regularly drops close to zero, banks charge you for that. Overdraft fees, monthly maintenance fees are waived only if you maintain a minimum balance that you cannot maintain. According to the Consumer Financial Protection Bureau, American banks collect roughly $9 billion in overdraft fees annually. The people paying those fees are overwhelmingly low-income account holders, people who are paying a premium for the privilege of being poor. This is not a side effect of the banking system. It is a revenue model. Then there is the credit system. Your credit score, a 3-digit number that determines your access to housing, your interest rates on loans, and in some states, even your employment prospects, is built through a process that inherently disadvantages people who are starting without financial resources. To build credit, you need credit. To get credit, you need a credit history. To have a credit history, you needed to have had credit in the past. For someone with no family cosigner, no established banking relationship, and no understanding of how the system works, entering this loop is genuinely difficult. And while you are outside it, or on the margins of it, every loan you do access costs more. Your car loan carries a higher interest rate. Your apartment requires a larger deposit. Your insurance premium is higher. Being poor is expensive. That phrase, popularized by journalist Barbara Ehrenreich and economists who study poverty, is not a metaphor. It is a mathematical reality. Now move up to the middle class, the group that believes it has escaped the trap, but is in many ways running a more expensive version of it. The middle class in America is largely a class of consumers and debtors, not owners and investors. The defining financial instruments of middle-class life are a mortgage, a car loan, student debt, and a retirement account that is dependent on market performance, and the fees they often do not notice. These are all liability-heavy instruments. They involve spending or borrowing money to acquire things, some of which appreciate and many of which do not. The wealthy, by contrast, are primarily owners. They own equity in companies. They own real estate that generates income. They own financial instruments that pay dividends and interest. The core distinction between the wealthy and everyone else in America is not income, it is ownership. And the tax code is structured to reward ownership. Capital gains taxed at lower rates than wages. Depreciation deductions on real estate. Carried interest provisions that allow investment managers to pay lower tax rates than their secretaries. These are not loopholes accidentally left in the code. They are policies debated and passed by legislators who are themselves largely wealthy, funded by industries that benefit from their continuation. This is the extraction mechanism in plain language. The system charges the poor for basic financial services. It charges the middle class for the debt required to reach a standard of living that the culture defines as normal. And it rewards the wealthy for the act of owning things through tax structures, appreciation, and compound returns that grow with or without their active participation. Money, in the American system, makes more money for those who already have it and makes it harder for those who do not. There is no cleaner illustration of how the American system extracts wealth from the aspirational class than the story of higher education and student debt. It is a story that begins with a genuine truth. Education increases earning potential, and ends with a financial instrument that has transferred over $1.7 trillion of debt onto the backs of people who were, at 17 or 18 years old, that signing for it was the responsible, forward-thinking thing to do. The American higher education system is the most expensive in the world. A 4-year degree at a private university can cost $200,000, sometimes $300,000 when room, board, and fees are included. Public universities, once the affordable alternative, have seen tuition rise at more than double the rate of general inflation over the past 3 decades, driven by reduced state funding, administrative expansion, and an amenities arms race that has little to do with the quality of education and everything to do with competing for enrollment. And here is the part that is seldom explained to the 18-year-old signing the promissory note. Student loans in the United States are not dischargeable in bankruptcy. This is virtually unique among all forms of debt in American law. You can discharge credit card debt, medical debt, business debt, and, in some circumstances, even tax debt through bankruptcy. But student loans follow you. They survive bankruptcy. They can garnish your wages, your tax refund, and, in the case of federal loans, eventually your Social Security benefits. The government can collect on a student loan until the day you die. This arrangement was not always the law. Student loans became non-dischargeable through a series of legislative changes beginning in the 1970s and culminating in the 2005 Bankruptcy Abuse Prevention and Consumer Protection Act, a bill that passed with significant support from the financial industry, which had a strong interest in ensuring that student debt remained a permanently collectible asset. The people most affected by this policy change, the students taking on debt to access the education the economy told them was mandatory, were largely not in the room when it was decided. The result is a generation, actually now 2 generations, of Americans who did exactly what they were told. They went to college, they took the loans, they got the degree, and they entered the workforce carrying a financial anchor that constrains every subsequent decision, whether to take a lower-paying job that they are passionate about, whether to start a business, whether to buy a home, whether to start a family. The student loan is not just a financial burden. It is a structural constraint on the kind of economic risk-taking that historically built the middle class. Now, none of this means college is always a bad investment. It means that the return on investment of any specific degree, at any specific institution, at any specific cost, needs to be calculated before the debt is taken on, not after. A nursing degree from a state school at $30,000 in debt is a profoundly different financial decision than a fine arts degree from a private university at $200,000 in debt. Both are valid personal choices. Only one is a sound financial one. And 17-year-olds making these decisions deserve the information to tell the difference. Homeownership has been the primary vehicle for wealth accumulation in the American middle class for most of the 20th century. The equity built in a home, passed from one generation to the next, is how millions of families transferred economic security across decades. It is a real and important mechanism, and it has become dramatically less accessible to a growing portion of the population, not because of individual failure, but because of how housing policy, zoning law, and financial markets have evolved. The median home price in the United States has increased by over 400% in inflation-adjusted terms since 1970. Median household income has grown by far less. The ratio of home price to annual income, the fundamental measure of housing affordability, has reached historic highs in most major American cities. In markets like San Francisco, Los Angeles, New York, Seattle, Austin, and Denver, a median-priced home now costs 8, 10, 12, sometimes 15 times the median local income. The conventional mortgage guideline of spending no more than 3 times your annual income on a home is not just being stretched in these markets, it has become essentially fictional. This did not happen by accident. American housing policy for most of the 20th century actively subsidized homeownership for white middle-class families while explicitly excluding black and other minority families through a federal policy called redlining The systematic denial of mortgage lending and federal housing benefits in neighborhoods designated by race. The neighborhoods that were redlined received no investment. They deteriorated, and the families that lived in them were locked out of the primary wealth-building vehicle of the post-war economy, not because they did not want to own homes, but because the federal government and the banking system refused to let them. The wealth gap between white and black families in America today, the white family has roughly 8 times the median wealth of the black family, is not a coincidence. It is the compound interest of policy. Today's housing crisis has a different face but some of the same bones. Exclusionary zoning. Laws that prohibit the construction of multifamily housing in large portions of American cities artificially restricts housing supply in the most economically productive areas. This keeps home values high for existing owners who are disproportionately older and wealthier, and keeps purchasing power low for younger and lower income people trying to enter the market. The homeowner benefits from scarcity. The renter and the first-time buyer are harmed by it. And the political economy of housing, where homeowners vote in higher numbers and have a direct financial interest in maintaining restrictive zoning, makes reform slow and difficult. Meanwhile, institutional investors, large corporations and private equity firms have entered the single-family home market at scale over the past 15 years, purchasing properties in cash in markets across the country and converting them to rentals. This further reduces the supply of homes available for purchase by families, drives up prices, and extracts rental income from households that would prefer to be building equity. The individual family competing against a corporation with $1 billion acquisition budget and a cost of capital advantage is not competing on equal terms. They are not even playing the same game. The practical implications of all this are straightforward and uncomfortable. If you do not already own property in a high appreciation market, getting in is harder than it has ever been for an ordinary earner. That does not mean it is impossible, but it means that the strategy has to be smarter than the previous generation's strategy, which was essentially get a job, save a down payment, buy a house, wait. The waiting part no longer works the same way. And in some markets, the honest financial analysis says that renting and investing the difference in the stock market is a better wealth-building path than buying an overpriced home with a high-interest mortgage. That is a deeply uncomfortable thing to say in a culture that has defined homeownership as the cornerstone of the American dream. But the math does not care about the dream. There is a retirement crisis unfolding in slow motion in the United States, and almost nobody is talking about it with the seriousness it deserves. Roughly half of American workers have no retirement savings whatsoever. Among those who do, the median balance for households approaching retirement age is nowhere near sufficient to fund a retirement of any real duration, and the systems that previous generations relied on to bridge that gap have been systematically dismantled over the past 40 years. For most of the 20th century, the dominant retirement structure for American workers was the defined benefit pension. Your employer promised you a specific monthly payment in retirement, calculated based on your years of service and your final salary. The investment risk was on the employer. The employee knew what they were getting, and while pensions were never universal, they were primarily available to unionized workers and government employees. They provided a genuine floor of retirement security for a significant portion of the workforce. Beginning in the 1980s, the defined benefit pension began its decline, replaced by the defined contribution plan, 401k. The shift was presented as a modernization, a way to give workers more flexibility and control over their own retirement futures. What it actually represented was a transfer of investment risk from the employer to the employee. The company no longer guarantees you an income in retirement. It offered to match some of your contributions to an account that you then invested in the market, managed largely on your own, and hoped was sufficient by the time you stopped working. For the financial services industry, this was a transformative moment. Trillions of dollars that had previously sat in professionally managed pension funds were now flowing into individual accounts, managed by workers with no investment training, advisory capacity, or institutional bargaining power. Fund management fees, Expense ratios and advisory charges that would have been negligible in a large pension fund became, at the individual account level, a significant and continuous drain on returns. A 1% annual fee sounds trivial. On a $400,000 portfolio over 20 years, accounting for the compounding returns lost to that fee, it can cost the investor over $100,000, 1%. That money does not go to the worker. It goes to the financial institution. And then there is Social Security, the program that most Americans implicitly assume will catch them if everything else fails. Social Security is a critically important program. For roughly a third of retirees, it provides more than 90% of their income, but it was never designed to be a complete retirement plan. The average Social Security benefit in 2024 was around $1,800 a month, roughly $21,000 a year, below the federal poverty line for a two-person household. It is a floor, not a foundation. And its long-term solvency, given current funding trajectories, is a genuine concern that policymakers have not adequately addressed. The retirement picture, painted fully, is this. The generation of Americans currently approaching the end of their working lives is the first generation to have spent the majority of their careers under the 401k rather than the pension system. Many of them were not given adequate information to make good investment decisions. Many of them cashed out their 401k balances when they changed jobs because the money was sitting right there and the bills were real. Many of them were sold high-fee mutual funds by advisors who were not legally required to act in their interest until regulations were tightened in recent years. And many of them are arriving at retirement age with far less than they need, in a healthcare system that is the most expensive in the world, with a social safety net that is among the thinnest of any developed nation. This is a systemic failure, and it is not the fault of the individuals who lived through it. It is the result of policy choices, industry lobbying, and a cultural narrative that told workers they were empowered by having their retirement in their own hands, while quietly leaving them without the tools to manage it. Now let's talk about how the tax code was built and whose favor it was primarily built in. The United States Federal Tax Code is approximately 74,000 pages long. It is, by any measure, one of the most complex legal documents in human existence. And that complexity is not an accident. It is the accumulated residue of decades of lobbying by industries, corporations, and wealthy individuals who hired lawyers, accountants, and lobbyists to carve out specific provisions, deductions, credits, and structures that benefit their specific situations. The average working American, filing a W-2 and a standard deduction, interacts with a tiny fraction of this document. The wealthy family with a team of tax professionals interacts with a very different fraction. Consider the carried interest provision, which allows private equity and hedge fund managers to classify their compensation, the fees they earn for managing other people's money, as capital gains rather than ordinary income. This means they pay a maximum federal rate of 20% on that income, rather than the 37% top marginal rate that applies to ordinary wages. Warren Buffett has famously pointed out that he pays a lower effective tax rate than his secretary. This is not because the system is broken. It is because the system is working exactly as it was designed to work for people with the resources to shape it. Consider the step up in basis provision, which allows inherited assets to be revalued at the time of inheritance rather than at the original purchase price. If a wealthy parent purchased stock decades ago at $10 a share and it is worth $200 a share when they die, the heir inherits it at the $200 basis, meaning the $190 gain is never taxed, ever, permanently erased. For a working person who sells their home or their small investment account, every gain is taxed. For the heir of a large estate, decades of appreciation can transfer completely tax-free. The wealth compounds. The tax burden does not. Consider the mortgage interest deduction, which allows homeowners to deduct the interest paid on their mortgage from their taxable income. This sounds like a benefit for the middle class, and it was originally framed that way. But in practice, the deduction is worth more to people in higher tax brackets and to people with larger and more expensive mortgages. The family with a $600,000 mortgage in California gets a far larger tax benefit than the family with a $150,000 mortgage in Ohio. The policy rewards the already advantaged and provides progressively less benefit as income and home value decline. None of this means the system is irredeemably corrupt or that participation is futile. It means that the rules of the game are written by and for people with capital, and that the most important thing any working person can do is understand those rules thoroughly enough to use every provision that is available to them. 401k, the Roth IRA, the HSA, and the self-employment deductions. These are real tools that are accessible to you. The gap between what is available to a sophisticated middle-class taxpayer who understands the code and an unsophisticated one who does not is tens of thousands of dollars over a career. That gap is information. Here is where we turn the corner. Because this audiobook is not meant to leave you angry and helpless. It is meant to leave you clear-eyed and equipped. And the truth is, even in a system that is tilted, even with rules that favor the already wealthy, there are paths, real ones. Paths that people with ordinary incomes have walked to genuine financial independence, not because the system helped them, in spite of the fact that it didn't. The first move is the one that underlies everything else. Build capital. Small, consistently, starting now. Capital is the thing the system rewards. Capital generates returns. Capital provides options. Capital is the difference between having choices and not having them. And the only way to build it from a working income is to spend less than you earn and to invest the difference in assets that grow. This sounds simple because it is simple. It is not easy, but it is simple. And simplicity in personal finance is a profound advantage. Index funds remain the most powerful tool available to the ordinary investor. Low cost, broadly diversified, tax efficient, and historically the best performing strategy for most retail investors over long time horizons. The Vanguard Total Stock Market Fund, the Fidelity Zero Funds, the iShares Core S&P 500 ETF. These instruments give you ownership, real ownership of the American economy. Not a bet on one company, not a guess about which sector will outperform. The whole thing. When corporate America profits, you profit. That is the category of people the system rewards. And index funds are your ticket into that category at any income level. The second move is to understand and aggressively use every tax advantage available to you. The 401k reduces your taxable income today. The Roth IRA eliminates taxes on your growth forever. The HSA is the most tax-efficient account in the entire code, and almost nobody uses it to its full potential. If you have any self-employment income, any freelance work, any side business, any consulting, you have access to additional deductions and potentially a solo 401k that allows you to shelter even more income from taxes. A good CPA who specializes in personal finance and small business pays for themselves many times over. This is not a luxury for the wealthy. It is a strategic necessity for anyone serious about building wealth. The third move is to be ruthlessly strategic about housing, not emotional, not driven by what your parents did or what your neighborhood expects. Strategic. Run the numbers on renting versus buying in your specific market. Consider house hacking, buying a multi-unit property, living in one unit, and renting the others to offset your mortgage cost. This strategy alone has launched thousands of ordinary earners into real estate ownership and passive income with far less capital than traditional homeownership requires. The wealthy have always understood that real estate is most powerful as an income-generating asset. The middle class was sold real estate as a place to live and told to hope it would appreciate. There is a meaningful difference between those two relationships with property. The fourth move is to build income streams beyond your primary job. Not because your job is inadequate, but because the system does not reward dependence on a single income source. A second income, even a modest one, even a few $100s a month from a skill monetized, a digital product sold, a service offered on weekends, provides financial resilience, accelerates your savings rate, and, if structured as a business, opens tax deductions that a W-2 salary never will. The wealthiest people in America almost universally have multiple income streams. That is not a coincidence. It is a strategy. And the fifth move, perhaps the most underrated of all, is to invest in your financial education relentlessly and continuously. The gap between what the financially sophisticated know and what the average earner knows is not measured in intelligence. It is measured in information. Books like The Psychology of Money by Morgan Housel, A Random Walk Down Wall Street by Burton Malkiel, The Little Book of Common Sense Investing by John Bogle, and I Will Teach You to Be Rich by Ramit Sethi are not academic texts. They are practical, readable, transformative guides that cost $20 and can redirect the entire trajectory of a financial life. The return on investment of reading one good personal finance book is difficult to overstate. You have just spent 30 minutes looking at something most people spend a lifetime avoiding, the actual architecture of an economic system that is not designed to help you get ahead. And I want to acknowledge something. That is not easy material. It is not comfortable to hear that the deck is stacked. It is not comfortable to see the mechanisms clearly. There is a part of the human mind that would rather believe the game is fair, because if the game is fair, then struggling means something is wrong with you, and that, at least, feels like something you can fix. The truth is more complex and, ultimately, more freeing. The game is not entirely fair, and nothing is wrong with you. You were not taught about compound interest in school because the curriculum was never designed to produce investors. It was designed to produce workers. You were not told the full cost of student debt at 17 because the institution processing your loan had a financial interest in your signing. You were not warned about lifestyle inflation and subscription creep because the economy depends on your spending. You were not handed the tax code and shown which provisions benefit you because the people who benefit most from those provisions have a strong interest in your not noticing them. This is not a conspiracy. It is a system. Systems have inertia. They have beneficiaries who protect them. They change slowly and imperfectly, and usually only when enough people understand them well enough to demand something different. But systems also have gaps. And in those gaps, in the index fund, in the Roth IRA, in the house hack, in the side business, in the deliberate, consistent, unsexy work of spending less than you earn and investing the difference, real people build real wealth. Every single day in this country, people who started with nothing and were given no advantage beyond information and discipline change the trajectory of their families. They break the cycle. They become the first in their line to retire with dignity, to help their children start without debt, and to have options. That is available to you, not because the system will hand it to you, not because someone is coming to fix the rules, but because you now know enough to navigate the rules that exist, to use what is available, and to stop being surprised by a game whose mechanics you have now seen clearly. You are not bad with money. You were set up to fail, and now you know the difference. That knowledge is the beginning of everything. The system was not designed for you to win. Win anyway.